Chris Hone, I believe is how you pronounce his name.
Yeah.
Chris Hone. He sent a letter to Google and Amazon. Amazon today, after already announcing 10,000 layoffs, they just said again, Andy said, prepare for more layoffs in 2023. And these are not factory workers. These are white-collar, high-paying jobs that are being laid off here.
They're surplus elites.
Surplus elites. It is definitely a part of the zeitgeist right now. So they're going to reduce headcount massively. But in this letter to shareholders, he points out, notably, not just, hey, Google needs to do a RIF, a reduction in force, but he points out a more granular point that I want the panel to talk about here, which is, he says, hey, you need to reduce the actual salaries at Google, the average salary being $296,000, 67% higher than an incredibly well-paying workforce, Microsoft. Quote, we acknowledge that Alphabet employs some of the most talented and brightest computer scientists and engineers, but these represent only a fraction of the employee base. Many employees are performing general, sales, marketing, and administrative jobs who should be compensated in line with other technology companies. And he says we need to establish an EBITDA margin target, as you can see in this chart, and reduce the losses on other bets, perhaps increasing share buybacks as well. So what we're looking at here now after
What an incredible
Facebook,
business. My God.
I mean, the business is nuts. Freeberg,
Wow.
you worked there. What in this rings true to you or not? And then how many people does Google need to employ to operate the business and invest in the future of the business in your mind? They have 187,000 employees at Google. It's grown 24.5%, rounded up 25% year over year. They grew 25% year over year in their business. How many people need to run this business to have it aggressively grow?
Look, I think there are two main drivers of the issue that Google, maybe Meta, maybe Twitter, prior to Elon's involvement, and really Silicon Valley as a whole, the bigger companies have faced. The first is the war for talent. The war for talent started, I mentioned this last time, around 2004, 2005, because prior to that, there weren't as many grads coming out of undergrad with computer science degrees, right? I think 10% of grads in the Bay Area schools were finishing with computer science degrees. Today, the number is like 60%. So, around that time, the war for talent led organizations, particularly Google, down a path of offering more perks and benefits to their employees to create a workplace that was more competitive. And that ends up being a slippery slope, because then other organizations try and find parity, and then other organizations try and overdo it and push it even further. So this leads to both wage inflation across the industry, but it's also led to almost like the acceptance or the allowance for degrees of complacency. And so I'm not saying that the workforce is all complacent, but I do think that complacency is forgiven. Some amount of complacency. I'm going to take a Friday off. I'm going to take 2 Fridays off. All of a sudden, I'm not working any Fridays. The other thing that's happened is as this workforce has aged, I worked at Google 20 years ago, and a lot of the folks I work with, almost all of them now, have families. At the time, everyone was young. And as the demographics of Silicon Valley has matured, you have more people that are less about killing themselves and giving everything that they have to their organization. And they're more interested in being with their families and now spending less time at work, especially in light of the fact that compensation has ballooned to a point that you can now live a very, very comfortable lifestyle. And you don't need to have a big payday in order to be able to take really good care of your family, which was the case as a startup. And then the other issue is just one of innovation. At Google, if you work on a new project and it doesn't work, there's no loss. You still have your job. And they've started programs where they'll give you equity in new startup ideas, or they'll give you all the stuff. So they'll give you upside if you win. They'll give you bonuses if it succeeds, but there's no downside. And so the pain and the burn that you would feel as a startup founder or as someone building a new business isn't experienced or realized. And I don't need to tell you guys this, but for anyone else that's listening that may not really be fully aware, the lack of pain, the lack of risk, the lack of downside, the lack of having no safety net and falling through the pits removes so much of the incentive to succeed and to drive and to innovate. And I think that's become part of the complacency problem that's caused larger organizations to simply say, let's throw more heads at the problem. And when you just throw more heads at the problem, you have more of kind of talent war problem that I mentioned, number one.
What is the average salary? 280,000?
300,000, rounded up. Yeah. That doesn't, I don't know if that includes benefits, whatever, but let's just call it 300,000. Yeah.
And by the way, that doesn't mean that those people should all get fired. But I think it speaks to the fact, I think they're wonderful people there. Some of my best friends work at Google. It's a great organization. People do incredible work there. But in terms of return of dollars invested as a shareholder, that's the question. That's the analysis. That's the scope that the shareholder is looking at is, do I want to spend $1 to make $1.05? Or do I only want to spend $1 where I know I'm going to get $1.80 back? And so if you just bucketed where the dollars are going, you would end up saying, you know what? I'd rather just focus on the places where I spend $1 and I get $2 back or $1.80 back. And I don't want to do any of the stuff where I spend $1 and make $1.05 back. And that's called ROIC, or return on invested capital. And that includes return on invested human capital. And so the analyst in the stock that's an investor in the stock will look at it through that lens. Whereas everyone that's working there is still contributing meaningfully. They're still doing valuable work. But in terms of return on invested capital, a good chunk of the projects are not driving the majority of the value. A minority of the projects, a minority of the headcount is driving almost all the value.
I mean, if you sensitized it to what you said, David, if it was just 75 or a half that number, then, the stock goes up 35% overnight. And if it goes up to the full number, the stock goes up 65% overnight.
I think that's totally feasible. And then I think what you do is you take $10 billion a year and you have a high accountability model that you speak to the street about. And you say, here's how we're going to hold ourselves accountable to investing this $10 billion every year. And not just have everything be a nebulous 15-year project. And then it's always a 15-year project and you're always just burning cash to go after those projects that are highly nebulous.
If you had to steelman the other side, I think the argument would be, I would say they would make probably three arguments. Argument number one is like, look, don't get overly distracted by other bets because it's a small category of spend and we've contained that cost pretty rationally relative to the rest of the core business. The second thing that they would probably say is there's an enormous amount of work that is never seen by Wall Street that explains how good our service is, whether that's, in early iterations of, technical capability like GFS and Bigtable to things like TPU, to things like TensorFlow. And all of that builds up, all the things that DeepMind does, all the compute we have to throw against search to support that. So I think they would probably say, well, people probably don't have a great sense of today that it's not just 25% of the team that's required. And then the third thing is what they would probably say is it's very hard to explain, but Google has all kinds of other things that they do for free to create the ecosystem so that the internet works well. I heard this one thing where somebody was explaining that Google is like, the DNS server, right? Google is the time server and all of this stuff they do for free. And all of it is just about making the internet work more efficiently, and that has some cost. So that's probably how they would steelman how to build back up to some number. But it's probably, there's still a gap between that number, David, and what their prevailing headcount is.
Yeah, I think that's totally true, because the infrastructure team led by Urs is the most remarkable engineering organization on planet Earth, in my opinion. And they have laid fiber lines across the Atlantic. They have built their own data center infrastructure, their own switches, their own silicon. Like, everything is built by this team from the ground up, from first principles, and it gives extraordinary moats and advantages to the business. It makes the internet a better place. It allows ultra fast, super cheap YouTube video viewing across the internet. I mean, there's just so much of these core advantages in the business. But if you look at the headcount over time, you have to ask yourself the question, how many of these investments that are core are really, captured in the headcount that blossomed from 2013, 47,000 people. So that the business has gone up in headcount by 4x in the last 9 years. One of the things that Jeff Bezos was always so incredible at, and I saw him give a speech on this at one point. Bezos gave a speech that I saw, and he said, we are really good at failing. And he showed all these projects that Amazon tried. And he said, we tried A9. We tried to do our own search. We tried to build our own cell phone, the Fire phone. We tried to do this. We tried to do that. When they don't work, we kill them. And when they did work, they became multi-hundred billion dollar enterprise value creators for them, like AWS, which was one of these projects. And so Amazon was so good at taking the stuff that wasn't working, knowing when it wasn't working and ending it. And they were still able to drive an innovation engine. One of the challenges I see with Alphabet is that they are so good at bringing the best talent to work on these innovation problems, but where they're not good is saying, you know what, this isn't working, it's time to move on. And if they did just that, if they added that one disciplinary capability, then I think this, as you said, the market cap would go up by $600 billion.
What about this? I just want your reaction to this thing that a lot of people whisper in Silicon Valley, which is part of what the big companies should do. It's part of the positive game theory, is to not let these talented people actually leave. It's better to pay them $300,000 or $200,000 or whatever and stay at Microsoft and Meta and Google or whatnot, then go off and build a startup that could actually then disrupt them. And so, it's a cost worth bearing because it's actually mitigating
strategy,
future.
as
it's a blocker strategy, yeah. What do you think about that, Friedberg?
Super interesting idea. I think that the people that are likely going to actually be able to execute on that are going to leave and do it anyway.
Right. Those truly aggressive entrepreneurs are not going to be blocked.
Look, I was not super, I had made a little money when I worked at Google, but I was not super wealthy. And I left the vast majority of my stock options and RSUs on the table when I left Google in 2006 to start Climate Corp, because I could not help but do that. I could not help myself. I had to go do that thing.
Of course.
And I think the kinds of people that are going to succeed in entrepreneurism cannot help themselves. It doesn't matter how much money is being thrown at them.
Here's the chart. Basically, these companies have been correlating their spend and their headcount to their revenue, not what's necessary. You look at Alphabet, total employee change since 2018, 95.36%.
I mean, I don't know. That looks pretty good to me.
Revenue, 132%.
That's pretty good.
But it doesn't look like they were massively overhiring, if you ask me.
Totally.
So what are you guys talking about?
So maybe I'm wrong. I will say, look, a big part of Larry Page's decision to shift the company from Google to Alphabet was he believed that the core business at some point would ultimately be disrupted, that the core advertising engine was going to be disrupted, and there wasn't going to be the sustaining long-term growth advantage in that business. Maybe he's been disproven, or maybe it hasn't been proven yet. But the concept was we need to find the next Google, and we need to build the next Google. And so we want to allocate capital within a portfolio of bets and have some number of those things, maybe not all of them, maybe not even a lot of them, maybe just one or two of them, turn into the next $100 billion revenue line for us. Now, he always said that that's going to take a long time.
He definitely underestimated the quality of Google search and the dominance of it. Now, it probably stands to reason that if we have enough innovation at the fundamental model level in AI, particularly like a bunch of really powerful multimodal models, the new form of search can disrupt Google. But the problem is they are so ahead of everybody else with respect to those models as well. So the real question is, even that next big leapfrog isn't going to happen without billions of dollars of capital invested. And, the most likely folks that are able to do it, I think OpenAI at some level. But again, they're going to always have to raise money from other folks. Google can self-fund it, and it makes an enormous amount of sense to drive that technical moat. So it just seems like Larry may have just been wrong.
What do we think is going to happen here? Are they going to make the cuts or not? You think do they have the ability to not make cuts and just ignore a 6% shareholder, Chamath? Or are they just going to make them and then we're going to go on to you?
I'll tell you the dynamic will be how much Ruth is able to convey. Ruth Porat is the CFO. And
she's hardcore.
She's hardcore. She's incredibly, everyone on that leadership team is incredibly impressive. But she has a very particular lens, a Wall Street lens, and she understands what the shareholders are thinking and looking at. And she will convey these points to the board. And there will be engineers, and Sundar is an engineer, and he's very good at gathering the different points of view and having balance around this. And he will share his points of view with the board. And I think ultimately it will come down to, my guess is, like we just talked about, some portfolio allocation decisions, which is how much risk and how much beta, how much alpha, and do we have the right mix in our portfolio? And it is inevitable there's going to be some cutting. So I think that there will likely be some reduction.
5%, 10%, 10,000 employees? That seems like the number that people are going with.
Yeah, let's see.
That would be my guess. Okay, Sachs, what is your take on austerity measures and moving to an age of excellence and efficiency, which is happening inside of the tech industry as we speak.
I think Freeberg's right that these companies could operate a lot more efficiently. I think there's an economic argument there, but I want to up-level it and talk about the cultural aspect of this for a second, and also bring in two of the huge stories this week, the SBF story, the interviews he did with the New York Times and Vox, and then this hysteria around, what's happening at Twitter. Look, I think that something clearly has hit a nerve here in this last week, where you have all of these employees who have voluntarily left, creating all of this drama. And, Antonio Garcia Martinez had a good quote about this. He said, what Elon is doing is a revolt by entrepreneurial capital against the professional managerial class regime that otherwise everywhere dominates. And that same PMC, which includes the media, is treating it as an act of lèse majesté. There's another version of this that came out a couple of weeks ago.
And by the way, lèse majesté just means like you're insulting the monarch, the ruling class. It's treason.
You're insulting the crown. There's a good one here. There's an article in Compact Magazine a couple of weeks ago where the editor, Jeff Schellenberger, tweeted, the layoffs at Twitter are no different than what's happening across Silicon Valley, but because of the ideological antagonism of the professional left to Musk, they make clear what's at stake. The collapse of a jobs program for surplus elites. And then there's a great quote from this article, which
that's so hard hitting.
I know. It's really, it hits a deep nerve. I'll get into why.
Differently.
Yeah, exactly. So a quote from this article said, one of the biggest and least talked about social questions in the West is how to economically provide for our own modern version of France's impecunious nobles. That is, how to prop up high status people who can't really do much economically productive work. Wow. I mean, like this was
pretty brutal. Yeah.
Yeah.
Brutal.
Now, so listen, I think this is really hitting a nerve because the fundamental quid pro quo of our civilization is that in order to achieve economic and social advancement, you go to college and get a degree and you submit to voluntary re-education of yourself at one of these woke madrasas, one of these re-education camps. That's the quid pro quo. And you get a degree. Now, some people
Did your punch-up guy write that intro?
No. Look, this is what I believe for a while. Now, there are some number of people who get useful degrees like computer science or engineering, but huge numbers of people get degrees in, like we talked about, the basket weaving or whatever the politically correct degree is du jour. And they graduate with $250,000 in debt and no marketable skills, right? And what was propping up all of these people were these fantastically wealthy monopolies, tech companies that were hiring huge numbers of these people. Now, all of a sudden, we get to a point where we're in an economic recession and these companies are starting to do layoffs and they're starting to do a little bit more soul searching about who's really adding value. And people are starting to get laid off. And I think this hysteria is coming from a place of deep insecurity.